So in spite of what the thumbnail says, I won't be talking about my life's biggest mistakes. Instead, we'll do something more relevant as we look at the biggest life insurance blunders. These are mistakes I've made in the past, and I'll also source a few from some emails I've received and also websites like mouthshut.com, Google reviews, etc. to have a more comprehensive picture of where people are going wrong. Now, these mistakes could have happened while buying, managing, or claiming the policy, so I'll cover all three. This won't be just term insurance specific. I know there's already a lot of content on term, so I'll include ULIPs, traditional plans like moneyback, endowment, and also group life insurance policies. To the extent possible, I leave out the common ones. So mistakes like insufficient coverage, a delay in the purchase, not updating the policy, not disclosing health conditions, etc. And instead, I'll be covering the more uncommon mistakes that surprisingly we all make, either accidentally or by ignorance. And finally, and wherever possible, I'll also tell you what the law, the IRDA, has to say on it and how we can protect ourselves against these mistakes. The list isn't small. I found at least 11 mistakes, 11 uncommon mistakes, and I'm pretty sure you too will be guilty of committing at least 2 or 3 of these blunders. So keep a count of your mistakes, let me know in the comments, and let's begin. Okay, so this is not uncommon. It's a very common mistake, and I'm certain many of you watching this video have been a victim of this, with some of us still carrying those policies like an albatross around our necks. The problem starts with the way these policies are marketed. I mean, picture this for a proposition. You pay 1 lakh rupees for the next 10 years, and then from the end of the 12th year, you'll receive 1 lakh rupees every year for the next 50 years. Now, I don't know if there's actually a plan like this, but if there is, then pitching something like this to any regular person is frankly a piece of cake. But you show this same construct to a mathematician, and he or she would say, "Kya bakwas plan hai? This doesn't even cover inflation. It's an IRR of just 6.3%. Of course, I must add that this return of 6.3 is guaranteed, so that's good. And it's also tax-free. So these two advantages have to be considered alongside the 6.3% return number. But irrespective, the point I want to stress here is that policyholders often misread the returns component of these policies, which is typically between 4 and 6% because of the way it's marketed. And once we realize it, it leads to a lot of disappointment and regret. My point is, such situations are definitely avoidable with some simple mathematics and basic research on the internet. So if you haven't been doing it, please don't skip this part. Now, one of the plus points of any life insurance policy is that the premium remains constant for a pretty long time, and so does the sum assured. But if we think more realistically, our sum assured is actually going down, and that's entirely on account of inflation. Just to put that in numbers, a crore of sum assured today is probably worth 13 lakh rupees at an inflation rate of 7% 30 years from now. So the mistake most of us end up making is that we fail to account for inflation eroding the real value of sum assured over time, which means there's actually a gap, a significant shortfall with respect to the future financial needs of the family, which starts from the day we buy a life insurance policy. I think a lot of us, including me, have been ignoring this, and as a solution, one can either take a second term insurance policy after a few years like I have done, or secondly, you can also opt for policies which have an accelerating sum assured feature. That is, your life insurance coverage keeps increasing every year by say 5% or something. I think some companies have this option, and if you're keen on getting more information on this, then I'll suggest you book one of those free 30-minute consultation calls with the folks at Ditto. It's a service even I availed a few months back when I was confused on whether I should port my health insurance policy or not, and the advisor's suggestion really helped me. In fact, I was pleasantly surprised that they didn't try to sell me anything. My problem was resolved in the first call itself. The agent did not call me a second time attempting to cross-sell something. There was no pushing, shoving, emotional atyachar. Believe me, it was an absolutely wonderful experience. So if you haven't tried Ditto, then do try them out. And if you've interacted with any other agent from somewhere else in the past, you'll know what a delightful interaction it is. As always, the booking link is available in the video's description. Oh, so this is a bad one. And one blunder I came across is where a policyholder purchases an endowment policy believing it to be a viable solution for his or her short-term parking of money. Now, the reason this happens is because many of us substitute a traditional life insurance policy, or if we don't do it ourselves, we are told by our neighborhood LIC wale uncle that this policy is a good alternative for a fixed deposit, or better still, it's a tax-free fixed deposit. Now, this is still fine if you're a super conservative person and your investment window is a good 10-15 years from now. But if the tenure you're looking for is 2 or 3 years, then an endowment policy is an absolute non-starter, as all such policies are for at least 5 years with typical maturities ranging from 10 to 20 years. So it's mostly a case of mis-selling, but as a thumb rule, any life insurance policy that has an investment element to it, so an endowment, money back, annuity, or even a ULIP, they all require a long-term commitment, not just by law, but also for it to be financially viable. So kindly watch out for that, and please ensure none of your friends or family members are making this mistake. Intermediaries play a big role in the insurance industry, not only distributing policies but also spreading awareness. Typical questions from any consumer would revolve around the different types of policies, specifics, the nuances of each policy, the plan's suitability based on individual needs, policy riders, coverage options, premium calculation, policy purchase, endowments, renewals, and much more. Agents, brokers, online aggregators, while they add a lot of value to the process, one must still remember, because the intermediary's income is linked to the sale of a policy, there's that inbuilt incentive to provide only that part of the information that suits them. For example, when selling a ULIP policy, every agent will talk for hours about how the fund has performed. 20% growth over the last 5 years, India is growing, production linked incentives, infrastructure, blah, blah, blah. But do notice they'll be very cagey when you start seeking information on things like the premium allocation charges, the surrender value of the policy, mortality rate, and stuff like that. That being said, we as consumers, although we are very trusting, we also have to be a little practical here, or rather, it would be a mistake on our part to not do our research and to take the intermediary's word for it. And what I'm saying extends to everyone: agents, the insurance company call center, brokers, and even ditto. Although knowing ditto, I'm certain they'll encourage you to do as much research as you want before deciding to work with them. Okay, now let's go deeper into the policies and especially the terms and conditions, which is where a bulk of the mistakes happen. My first area of inquisition is the free look period, and unfortunately, most policyholders mistakenly believe that they can cancel their life insurance policy during this period without any financial implications. Well, that's not true, because while the insurance regulator mandates a free look period of 30 days beginning from the date of receipt of the policy document, upon cancellation during this period, the rules allow the insurer to deduct certain expenses while calculating the refundable amount. Specifically, there are 3 key charges that the insurer can withhold. The proportionate risk premium. So if the policy has run for 20 days, then the insurer can deduct the risk premium, the mortality charge pertaining to those 20 days. The insurer can also deduct the stamp duty. And thirdly, the cost of any medical examination that the insurer has conducted. I don't think any agent or even any marketing material issued by a life insurance company talks about this. They'll just majestically say there's a 30-day free look period. But when the refunded money comes back with these deductions, then obviously the policyholder is pretty dissatisfied. So Jagruk Baniye, Jagruk Janta, as my friends at Labor Law Advisor would say it. Another relatable TNC mistake is on the grace period and policy lapses. In fact, I'll say there are 2 kinds of policyholders. The first kind is someone who isn't aware of anything, including the fact that the policy lapses if one doesn't pay the premium, that he or she might lose all benefits and the revival process is not guaranteed, and that every life insurance policy offers a grace period of 15 to 30 days depending on the mode of premium payment. Then the second set of policyholders are those who are aware of the policy lapse and the grace period offered, but have seriously misjudged the impact of this lapse in terms of coverage and claims. For instance, if a death claim happens during the grace period, the life insurer generally allows it. But if the policy were lapsed, then there's almost no chance of receiving the death benefit. Likewise, reviving a lapsed policy is not easy, with it requiring medical re-examinations, and this cost has to be borne by the policyholder. The premiums might be bumped up if something comes up, and can go to the extent that the reinstatement itself might also be denied. Now imagine getting into a reinstatement denied kind of situation when you're much older, say 50 years old, because if you have to enroll into a new term insurance plan then the premium will be like 3 times more as compared to when you initially bought it, let's say at the age of 30. As you see here, this mistake can be a rather costly one, so kindly avoid it by simply setting up an e-mandate or keeping renewal reminders on your computer. Speaking of which, I hope you've noticed my newsletters have started. I'm publishing one every week, mostly on a Thursday, and the response, the discussions around it have been very heartening. The community is big now, almost 30,000 subscribers. And thank you everyone for the kind messages. And if you're finding my work useful, then please do share it with your friends and connections. Right, so the indisputability clause is something many of us know, and according to Section 45, insurers cannot question a policyholder's declaration citing inaccurate or false statements made in the application or any report by the medical officer after 2 years of issuing the policy. So this Section 45 is very helpful for policyholders like you and me. It gives us some protection, and this protection is primarily to ensure insurers do not randomly or indiscriminately dismiss claims on the grounds of inaccurate declaration by the policyholder. Now, the common mistake, or rather the uncommon mistake, is when a policyholder believes that after the 2-year incontestability period, no insurer can dispute a claim. The truth is, there are exceptions, and an insurer can definitely challenge a claim, especially in the event of a fraud and also in case of material misrepresentation. Some examples would include things like falsification of age because the applicant wanted to pay a lower premium, non-disclosure of serious pre-existing medical conditions like a heart disease or cancer at the time of purchasing the policy, false information about occupation like claiming to be in a low-risk job, claiming to not smoke or consume alcohol and stuff like that. Now, the best way to avoid this particular situation is to be 100% truthful when filling out your application form. And if you have the slightest doubt, then please consult an experienced operator like Ditto who can guide you through the steps and help you take corrective action. Yet another uncommon mistake is our understanding, or rather the misunderstanding, of the nomination rules. You see, policyholders often nominate someone, typically the spouse or the children, as the policy's beneficiary without understanding that a nominee is not necessarily the final recipient of the insurance proceeds, and that the legal heirs are well within their right to contest this out in a court of law. In fact, there have been numerous court cases where nominees were denied payouts in favor of the legal heirs. And if you're wondering why, then according to the IRDA, or maybe it's one of the courts saying this, but according to them, a nominee merely acts as a trustee or a custodian to receive the death benefit on behalf of the legal heirs unless specifically stated otherwise. So as a policyholder, it is critical to align your policy nomination with one's will and legal heirs to avoid any disputes later. This will require you to regularly review and update your nominations, particularly after major life changes like marriage, death of a parent, a childbirth, etc. Remember, if your intention is for the nominee to be the final recipient, this should also be explicitly mentioned in the policy documentation to avoid any ambiguity. Relatively, when I did this podcast with Shehit a few months back, I recall him mentioning something called a rule of 4. So essentially, and I'm assuming Ditto says this to all its customers, that there should be 4 people who should know about your life insurance plan. Your parents, especially if you are unmarried, your spouse, it's very important, a cousin who is of a similar age as yours, and also a family friend who is also somewhere around your age. I think this rule of 4 is a good thing to have, so do make sure your loved ones know about your life insurance policy. Right, so when it comes to term insurance, the return of premium feature attracts many individuals who believe it to be a better deal since they get their premiums back if they survive the policy term. But when one looks at it mathematically, what are we exactly doing? For example, a regular term insurance policy with a term of 30 years for a 25-year-old would cost an annual premium of 10,000 rupees for a 1 crore sum assured, while the same 1 crore policy under a return of premium variant would come at 20,000 rupees per annum. So figure this, we are buying life insurance for the next 30 years and we are okay to pay double the premium during this time. But when we get back the premium, that is 20,000 multiplied by 30, so 6 lakh rupees, and assuming a 7% inflation, what we actually get back is worth just 78,000 rupees. It's something worth thinking about, and I'm sure all of you know this part, that instead, if we had applied this additional 10,000 rupees on a pure investment product, like say a flexi-cap fund, the results would have been far better. Now, a recent variant of the return of premium feature is zero cost term insurance. The concept of a zero cost term plan is very similar to an ROP, but it's definitely better given the fact that firstly, one doesn't have to pay almost twice the premium as was the case with ROP. And secondly, the policyholder can reclaim all premiums paid after he or she has reached a predetermined point during the policy term. So basically, the policyholder doesn't need to wait until the completion of the term. Essentially, there's an exit value option that's available. But honestly, in my view, this is just a mind game and it doesn't negate the fact that the premium you receive 20, 30 years from now has so much less value than the premium you pay today. Yes, it's a good marketing ploy that will attract customers, but that's just about it. And eventually, some basic mathematics will help you understand which variant of the term plan, the Seedha Saral regular term plan, or the return of premium, or the zero cost plan, which of these is best for you. Okay, now let's look at ULIPs, unit linked insurance plans, probably the most controversial word in the insurance space, and there's definitely a reason for this animosity. I remember when I was first told to sell ULIPs way back in 2004, when the premium allocation charge for the first year was a whopping 36%, and that's just not all. There were deductions made for policy administration, fund management charges, mortality, which is okay, it makes sense. But then there were also switching charges, surrender charges, partial withdrawal charge, discontinuance charge, and much more. Now, although modern day ULIPs have dramatically improved their charge structure, it's still the policyholder's responsibility to be aware of what is being charged and what's the impact of those expenses. For instance, if a ULIP were to knock off 36% of your investment in the first year, or if not 36, even if it was 5%, that's a good 5% lower returns that your corpus might achieve in that year. Since ULIPs are long-term investments, that gap of 5, 4, 3 or whatever percent can amount to a lot of money. Okay, now that I've said it, many of the recent ULIP offerings have what's called loyalty editions, which is marketed as something that can significantly boost one's ULIP returns. But the truth is, there is nothing significant about them. And secondly, not many policyholders are aware of how it works. I mean, it sounds good, right? Loyalty editions. But if one goes a layer deeper, then it's nothing more than a marketing stunt that's designed to stop you from surrendering your policy. The more you stay, the better it is for the insurance company. But for a policyholder, it might mean remaining stuck in an inefficient product just because of these sweet nothings. The final mistake I want to highlight in this video pertains to group life insurance policies. This is important because what was earlier seen only with banking partners or NBFCs, I'm now seeing a rising trend of life insurance companies working with fintechs to create custom group plans. I know this because when I was working at ET Money, a dozen or more life insurers would have approached me to design and distribute a group insurance plan, which obviously I didn't agree to. The reason being, a group life insurance policy does not carry all the same rules that apply to a retail policy. I've listed some of the differences on the screen here, but look at this. So firstly, the life insurance coverage expires when you leave the group or if the group ceases to exist unless a conversion option is provided by the insurer. Another important point is on the renewal premium, and while the amount remains constant in a retail policy, this number can vary in a group plan based on how the organization negotiates it. There are many more differences, but my point is a majority of policyholders mistake a group life insurance plan for a retail one and often assume that everything is exactly the same, which in reality is not the case. And with this uncommon mistake, we come to the end of this video. I sincerely hope you found these insights useful and you'll take extra caution and care when evaluating insurance policies, when working with intermediaries, when it comes to reading the rules, terms and conditions, and when selecting products. Take help wherever and whenever you are stuck. There are good people writing good blogs and articles on the subject, and there's always Ditto, a great platform to not just buy policies but also to get your doubts clarified. Just to recap, Ditto is India's highest rated insurance advisor with a rating score of 4.9 from 8,000 plus reviews on Google. They are backed by Zerodha. Ditto has been named LinkedIn top startup for 2 years in a row. They have invested in a strong claim support team and much more. You can always book a free call with them, but do that quickly as the slots are limited, and from what I've seen, they run out pretty quick. Once again, thank you for your time. Do like this video, subscribe to my newsletter, and I'll see you very soon. Until then.